They call it the Widowmaker trade for a reason. In January of this year, 2026, silver investors felt like they had finally won the lottery. The price hit an all-time record high of $121 an ounce. Reddit was celebrating. The silver squeeze was trending. People were putting down deposits on houses. They thought the dollar was dead and the age of metal had arrived. And then February happened. In the span of 10 brutal days, silver crashed. It didn't just dip, it collapsed. From 121 down to $77. That is a 36% drop in less than 2 weeks. If you were trading on leverage, you were wiped out instantly. If you bought physical coins at the top, you just watched a third of your net worth evaporate, at least on paper. But here is the strange part. Look at gold. Gold hit a high of $5,600. It pulled back to $5,000, a boring, standard 10% correction. While silver investors are having panic attacks, gold investors are sleeping like babies. And then, look at Bitcoin, the digital gold, the asset that was supposed to save us from the system. When the inflation news hit and when the Fed rumors started swirling, did Bitcoin rally? No. It crashed right alongside Nvidia and the tech stocks. It fell below $69,000. This brings us to the most critical moment of 2026. We are seeing what economists call the Great Divergence. For the last 10 years, everything moved together. When the Fed printed money, stocks went up, gold went up, crypto went up. But now, the music has stopped. The markets are splitting apart. Why? Because of one man, Kevin Warsh. The nomination of Kevin Warsh as the next Fed chair has sent a shockwave through the global financial system. He is a hard money hawk. He wants to turn off the money printer. And the market is terrified. So, where do you put your money right now? Do you buy gold, the sovereign shield that central banks are hoarding? Do you buy silver, the industrial rocket ship that just crashed to a bargain price? Or do you buy Bitcoin, betting that the digital age isn't over yet? Welcome to the Deep Dive. Today, we are going to travel around the world. We are going to visit the COMEX in New York to see how they rigged the paper price. We are going to the Shanghai Gold Exchange to see why China is paying $120 more for gold than we are. And we are going to look at the AI data centers that are sucking the world dry of silver. My name is Shawez Ahmad. This is the only financial briefing you need this month. Let's get to work. Before we pick a winner between these assets, you have to understand the battlefield. Most people think the price of gold is the same everywhere. You check your phone, you see a number, and you think, that's the price. It's not. In 2026, the global market has fractured. We are seeing a phenomenon called arbitrage. The West is selling, the East is buying, and the price depends entirely on where you are standing. Let's take a tour of the big four markets, because if you don't understand this, you will lose money. Stop number 1, the United States, the casino. The US is the paper market. The price you see on your screen, the spot price, is determined by the COMEX in New York. Now, listen closely. The traders in New York are not trading physical metal. They are trading contracts. They are trading the promise of 100 ounces of gold or 5,000 ounces of silver. For every 1 ounce of real gold in the COMEX vaults, there are hundreds of paper contracts trading against it. This is why the price crashed last week. It wasn't because a mine shut down. It wasn't because you sold your coins. It was because the CME group, the people who run the casino, changed the rules. On February 2nd, they raised margin requirements. They basically told the traders, if you want to bet on silver, you need to put up more cash. The traders didn't have the cash, so they were forced to sell. It was a liquidation event. The US determines the price, but it doesn't have the metal. Stop number 2. The United Kingdom, the bleeding vault. London is the storage room of the Western world, the LBMA. But here is the scary data point for February 2026. The London vaults are bleeding. We are seeing record drawdowns. Metal is leaving London. It is being put on armored planes. It is being flown to Switzerland. Why Switzerland? Because that is where the refineries are. They melt down the big Western bars and recast them into smaller Eastern bars. And then those bars fly to our next stop. Stop number 3, China, the black hole. China is the buyer. While New York plays games with paper contracts, the Shanghai Gold Exchange deals in physical metal. And right now, the price of gold in Shanghai is trading at a $120 premium over New York. Think about what that means. If you have a gold bar in New York, it's worth $5,000. If you teleport that bar to Shanghai, it's worth $5,120. This Shanghai premium is the smoking gun. It proves that physical metal is scarce. The Chinese are sucking the world dry of gold and silver to back their yuan and protect against the dollar. Stop number 4, India, the love trade. India is unique. In India, gold isn't just an investment. It is culture. It is religion. It is the dowry at a wedding. In 2026, the Indian rupee has weakened against the dollar. Usually, when the price gets this high, Indians stop buying. But this year, they are buying more. Why? Because they don't trust the banks. They don't trust the currency. They are converting their life savings into jewelry. So, the world is split. The West is selling paper promises. The East is buying real atoms. And historically, over the last 5,000 years, the side with the metal always wins in the end. Now, we have to address the elephant in the room: Bitcoin. For the last decade, the crypto community has told us a very specific story. They said, Bitcoin is digital gold. They said, Bitcoin is gold 2.0. It's faster, it's smarter, and when the system breaks, Bitcoin will be the ultimate safe haven. Well, 2026 has been the ultimate test of that theory, and the results are concerning. Let's look at the correlation. In February, when the rumors of Kevin Warsh becoming Fed chair started, the market panicked. Investors realized that free money was over. What did gold do? It held the line. It acted like a shield. What did Bitcoin do? It crashed. It traded exactly like a tech stock. When Nvidia went down, Bitcoin went down. When the Nasdaq went down, Bitcoin went down. Why is this happening? Because Bitcoin acts as a liquidity sponge. Bitcoin loves loose money. When the Fed is printing and interest rates are zero, people speculate. They buy Dogecoin, they buy NFTs, they buy Bitcoin. But when the Fed tightens, when liquidity dries up, speculative assets get sold first. We are seeing a separation of risk on and risk off. Gold is risk off. It's where you go when you are scared. Bitcoin is risk on. It's where you go when you want to gamble on growth. Does this mean Bitcoin is dead? Absolutely not. The technology is revolutionary. The blockchain is the future of settlement. But as an asset class in 2026, it is behaving like a high beta technology stock, not a currency. And here is the Warsh Shock factor. Kevin Warsh understands central banking. He is a critic of the Fed put. If he takes over, we could see a period of positive real rates. That means you can earn 5% or 6% just by holding cash in a bank. When cash pays you 6% and Bitcoin pays you 0% and crashes 20%, the math changes for big institutions. So, here's the verdict on crypto for 2026. It is no longer a hedge against the system. It is a bet on the system's liquidity. If you believe the Fed will pivot and print money again, buy Bitcoin. If you believe the Fed will tighten and crush inflation, buy gold. They are no longer friends. They are rivals. Now, let's leave the digital world and get back to the physical world. Let's talk about silver. I told you earlier that silver crashed to $77, but I also told you that I am aggressively buying this dip. Why? Because of the industrial deep dive. You see, most people think silver is just poor man's gold. They think it's just jewelry and coins. That was true in 1980. It is not true in 2026. Silver has become the most critical strategic metal on Earth. Let's look at 3 industries that are desperate for silver right now. Industry 1, the new solar, TopCon. You know about solar panels, but did you know the technology changed? We used to use PERC cells. Now, the world is switching to TopCon and HJT cells. I won't bore you with the engineering, but here is the only stat that matters. These new cells require 50 to 80% more silver per panel than the old ones. China is installing these by the gigawatt. They cannot build the energy grid of the future without massive amounts of silver paste. Industry 2, AI data centers. We talk about AI all the time. We talk about chips. We talk about cooling. But nobody talks about the connectors. High-speed data transmission requires the most conductive metal on the periodic table. That metal is silver. Every time NVIDIA sells a new AI server rack, it contains ounces of silver. This demand didn't exist 5 years ago. Now it is consuming millions of ounces. Industry 3, the military. This is the dark side of the demand. We are living in a geopolitical crisis, wars in Europe, tensions in Asia. Do you know what goes into a Tomahawk cruise missile? Do you know what goes into a torpedo? Silver zinc batteries, silver contacts. When governments are building weapons, they are price insensitive. They don't care if silver is $77 or $200. They need the missile to work. This is why I say the price crash was paper manipulation. The CME raised margins, yes, but did the solar factories stop building? No. Did the AI centers stop expanding? No. Did the military stop building missiles? No. The physical demand is inelastic. The paper price is volatile. That gap between the fake paper price and the real industrial need is the opportunity of a lifetime. So, we have the landscape. Gold is the sovereign shield. Bitcoin is the liquidity bet. Silver is the industrial squeeze. How do you play this? You use the gold-silver ratio. This is the compass that has guided rich families for generations. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, gold is roughly $5,000. Silver is roughly $77. That gives us a ratio of about 65 to 1. Here is the playbook I am using and that I recommend you study. The buy zone, ratio greater than 80. When the ratio goes above 80, meaning silver is very cheap compared to gold, you aggressively buy silver. Why? Because historically it always snaps back. The swap zone, ratio less than 40. When the ratio drops below 40, meaning silver has skyrocketed, you do something difficult. You sell your silver. And you use the money to buy gold. You trade the volatile asset for the stable asset. You lock in your wealth in the king of metals. Right now, we are at 65. We are in the middle. But because we are in a bull market, silver usually has a higher beta. If gold goes up 20% to $6,000, history tells us silver will likely go up 100% to $150. So, if you are young, if you want growth, and if you can stomach the swings, silver is the play. A critical warning on premiums. Before you run out and buy, you need to be smart. The dealers know there is a shortage. Right now, if you try to buy an American Silver Eagle coin, the premiums are insane. They might charge you spot price plus $15. That means you are paying $92 for a coin that is worth $77 on the market. You are starting the race 20% behind. Don't do that. Look for generic rounds. Look for 10-ounce bars. Look for vaulted silver, like PSLV or allocated storage. Don't pay for the pretty picture on the coin. Pay for the metal content. The market doesn't care if your silver has an eagle or a buffalo on it. It cares about the purity and the weight. Let's wrap this up with the big picture. The end game. We are living through a transition. The era of the paper dollar dominating the world is ending. We are moving to a multipolar world, a world of CBDCs, digital control, and hard assets, freedom. Your portfolio is your vote. When you buy Bitcoin, you are voting for a decentralized digital future. But you are taking on massive risk. When you buy gold, you are voting for history. You are becoming your own central bank. You are declaring independence from the system. When you buy silver, you are betting on the future of energy and technology. You are betting that the laws of physics, supply and demand, will eventually defeat the laws of the paper casino. My advice? Don't go all in on one. I personally hold a mix. Gold is my foundation. It's the money I can't afford to lose. Silver is my growth engine. It's the money I want to multiply. Bitcoin is my lottery ticket. It's a small position, just in case the digital maximalists are right. But whatever you do, Don't hold 100% of your wealth in fiat currency. Because the one thing gold, silver, and Bitcoin all agree on is this: the dollar is dying, the euro is dying, the yen is dying. They are melting ice cubes. The Widowmaker crash of February 2026 was painful, but it was also a gift. It gave you one last chance to trade your paper for something real before the next leg up. Don't waste it. I'll be back next time to talk about the CBDC rollout and the digital prison. Until then, keep stacking, keep learning, and stay free. I'm Shawez Ahmad.